Okay, so now let us start with the credit management topic. Yeah. So credit management in bracket, if you will see, it is written that receivable management. Okay, so this topic is basically managing the receivables, that is debtors. Receivable means debtors, no, and debtors we know they are asset of the business, that is current asset. So debtors are what? They are the current asset. So we have to manage the credit, that is receivables properly. So in this topic, we will study about the debtors management or receivables management. How to properly manage the receivables of a company. See, accounts receivable that we popularly called as a debtors, no, bills receivable, debtors, they are called as account receivables. Receivable means amount which a business has to receive, are also known as receivables, constitute a significant portion of current assets. So you know that in balance sheet there are two types of asset category. One is the fixed asset category and another is the current assets. So debtors will write under current asset, no? That is receivables, bills receivable, debtors, etc. They are together called as receivables, which will be part of current assets. So this you have to remember. So the receivables, debtors, bills receivable, etc. will form part of current assets. Actually, what is debtors? Debtors is the credit granted to the customers. Okay, receivables are nothing but credit granted to the customers. So if goods are sold on cash, no receivables will be there. Okay, normally then cash account will be debited. Their debtors account will not be debited. Okay, so two types of sales are there, no? Cash sales and credit sales. So if you are selling on credit basis, then only receivables will arise. Otherwise, cash account will be debited. So in cash sales, there will be no receivables. If goods are sold on credit, then only receivables are generated or created. Okay. Now, normally some business gives 15 days credit, some may give 1 month credit, some can give 3 months credit also. So you have to properly monitor your receivables, no? Whether you are collecting that amount properly. So it is very important to monitor your receivables or manage your receivables. Okay, receivables are the assets, accounts representing amounts owed to the firm as a result of sale of goods or services on credit basis. Okay, and they are shown in balance sheet. They can be also called as customers or book debts. So credit sale results in account receivable. Selling goods on credit result in increase in sales and ultimately the profits also. So when sale is done, entry will be normally cash account debit or bank account debit to sales account. This is the entry in case of cash sales. But if you are doing it on receivable basis, that is credit basis, you will debit the customer account, that is debtors account debit to sales account. Normally, practically, when we will do, no, we will write here the name of the customer account. Okay, A account debit to sales account. So that normally A's account will be debited, he will be coming under debtors and sales will be credited. Those who have done the tally entries, they will know that customer accounts are created under current asset category, debtors, and sales will be the income. So when we do the entry, normally that customer account is taken and sales is credited. So automatically entry will be posted in books of account. Okay, and when the customer pays the account, it will be reversed. Cash account will be debited, and that respective customer account will be credited. So his account will be closed. See, debit and credit. A account will be closed. Sales will be transferred to trading account, profit and loss account, and cash will be transferred to balance sheet. Correct, no? So credit sale result in account receivable. So selling goods on credit results in increase in sales, increase in debtors, and debtors will ultimately transfer into cash. But one risk is always there if you are selling on credit basis. That risk is known as risk of bad debts. Okay, sometimes what may happen that some customers may not pay the amount. Okay, so that you have to take very careful. That is known as managing the debtors. Okay. Now what happens if you are giving the debtors time to pay the amount? Your funds is blocked in the debtors because your goods is moving out of the business, but you are not getting the liquid cash in hand. So what will happen ultimately? Your funds is blocked. So for that purpose, you will require more funds to meet the working capital requirement. So this is also one thing which you have to take into consideration before giving credit. Okay. Normally, if cash sales is there, what will happen? Cash account debit to sales, goods will go out, cash will come in. You can use the cash for circulation purpose. But when you do on credit basis, what will happen? Goods are going out, but money is not coming in. What is debited? Persons. No, they will pay after 2 months, 3 months. So till that time, your money is blocked. Okay, you have purchased the goods that you have sold, but you have not got money. So what will happen? There you will require more funds to meet the working capital requirement. This is one of the consideration you have to take before giving decision on credit. Second thing you have to check is the risk of bad debts. Okay, so we can say that selling goods on credit is beneficial as well as dangerous. Why it is beneficial? Because if you are giving goods on credit, your sales will increase. Okay, so normally people will go to those shop who give credit facility. No? Okay, it is a general tendency. So it will result in increase in sales and profits also increase. But danger or risk is that disadvantage is the more working capital will be required. So you will be required to take overdraft facility from bank. On that you will have to pay interest. This is one of the disadvantage of credit sales, because you are not getting money from the sales immediately. So to purchase new goods, you will have to take the short-term loans, overdraft, etc. And on that you will have to pay the interest cost will be incurred. Okay, this is one thing. Second thing is that risk of bad debts, that customer may not pay. So these two disadvantages are there, and advantage is the increase in sales and increase in profit. Okay. So this is the introductory part of the credit management or receivables management. So therefore, we can say that finance manager has to frame proper policies and take decisions regarding sanction of credit to the customers. So you have to take into consideration many factors before deciding whether to give credit to the customer or not. This is the first thing. Accounts receivable management is therefore the process of decision making relating to the investment of funds in these assets in such manner that returns on the shareholders investment is maximized. Okay, so in receivable management now, you have to treat your debtors as an investment. Okay, from that you have to try to maximize your returns. Okay, how it can be done? One thing I'm telling you that you can charge interest for giving credit. This is one thing through which you can treat the debtors as an investment. So if you invest your money, let us understand what is the logic in this. Suppose you have given Mr. A goods on credit worth rupees 5 lakh rupees. You have given credit for 3 months. Let us assume that you have sold the goods on credit to Mr. A for 5 lakh for 3 months credit basis. Now, this amount of 5 lakh is blocked because you will sell the goods. Goods will move out of your business, but you will not get the 5 lakh immediately. You will get after 3 months. Now, this 5 lakh is blocked. Now, if you would have got this 5 lakh, you could have invested this now for short term basis. For example, if you invest this money in some bank on a short term basis, you could have got an interest of 5%. Now, since you are giving this goods on credit, you don't have this 5 lakh. So you are losing this opportunity of investing this amount in the bank. So what you can do, you can say that since I am giving you the goods on credit, you pay me 5% interest on 5 lakh, over and above 5 lakh. So this is known as opportunity cost. So this term is known as opportunity cost in economics. Opportunity cost means opportunity lost. So since you are giving this 5 lakh on credit, you have lost the opportunity for making the investment. No? So this 5% you will charge from the customer. This is known as opportunity cost. So similar, what is the logic in this? Similarly, you have treated your debtor as an investment, no, and charge from him 5% interest. So this accounts management or credit management is all about this only. How you can maximize the returns from the receivables, account receivables. Because account receivable involve a lot of opportunity cost. Because by giving the goods on credit, you are losing many opportunities. So that opportunity cost is a very important element for decision making. Okay, whenever you will make decision in financial management or in cost accounting or management accounting, you will have to take opportunity cost into consideration. If you will not take opportunity cost into consideration, the decision which you will be making will be not proper. So always you have to take into consideration opportunity cost by making decision, either in financial management, in cost accountancy, or in management accountancy. Opportunity cost is a very important element of cost. Okay. Because alternative decision situation will arise in practical situation. So you have to select the one, and by selecting the one, you're ignoring the others. No. So what is the opportunity cost that you have to take into consideration before taking any decision? Clear? So this is the concept of opportunity cost and treating the debtors or receivables as an investment and trying to maximize the return on shareholders investment is maximum. Clear this much, everybody? Okay. So now what are the objectives of receivable management? See, first objective is to increase the sales. Okay, this will be the first objective of any business. First, we should increase the volume of the sales. So if you are giving on credit, your volume will increase. Then second, you should monitor that you are settling that debt without any loss. Okay, then second is to earn higher return on investment. Just now we have seen, because of the concept of opportunity cost, you have to apply interest also. Then maintain adequate capital for the firm. This is all the important objectives of credit management. You should take care that you are getting the timely source of finance, overdraft, etc., because funds will be blocked. So that also you have to take care before giving the credit. So these are all the objectives of credit management. To promote international trade transaction. So normally, if you are giving on credit, no, international trade will be promoted. Normally, exports and import trades are on credit basis only. Okay. So in credit management or receivable management, what are the 6 important things which are required or parameters of credit management? First is the terms of payment. So by selling the goods, terms of payment will be decided. That is how you have to pay, till what time you have to pay. Okay, if installment facility is given, then first installment you should pay by when, second by when. That will be terms of payment. Then credit policy will be studied under receivable management. Then you will evaluate your credit. Okay, whether it is profitable to give on credit, how many days you have to give credit, that you should evaluate. Then you should decide on granting the credit. Okay, then last step will be, once you have granted the credit, then you should control, monitor that credit. Okay, so first thing, it will start from terms of payment, that is mutual discussion. Then credit policy, for how many days credit will be given. Then you should evaluate your credit policy, whether it is profitable or not. Then you will take the credit decision. After taking that decision, then you should monitor your receivables also properly. Okay, so there is timely collection, settlement from the data, etc., that we have to take into consideration before giving the credit. Terms of payment is what? Terms of payment vary in practice. It can differ from business to business. Some companies may extend liberal credit to customer. Okay, in some cases, customer may pay in advance. So these terms of payment will be depending upon business to business. If some business are very liberal, they will give liberal credit. On the other hand, some business may take advance also. So terms of payment will depend upon business to business. Like cash terms, if goods are sold on cash, that will be, you can say, when goods are sold on cash, payment received in advance along with the order or on delivery of goods. So it can be depending on business to business. They can say that pay us advance while giving order only, or some business will take the cash immediately after goods are delivered. This can be one of the payment system which will be followed by the business. Okay, then another system is, you can say, open account, in which credit sales are generally an open account. Means seller will ship the goods and sends the invoice. Credit terms are specified in the invoice that you should pay within this much days, this amount. This is another system. Then credit period. Credit period means the time allowed to the customers for payment. Remember, credit period means time allowed to the customers for payment. So it will be usually mentioned in days. So if a firm allows 30 days without discount, means 30 days the credit period. Okay. So credit period means what? Time allowed for the customers to pay. So if business is selling goods today, what within what time the customer should pay the amount, that is known as credit period. Okay. Then one cash discount concept is there. Cash discount is given normally to induce the customer to pay promptly. Okay, to encourage the customer for making prompt payment. For that, business normally give cash discount. Okay. Now see this term, it is very important. Credit terms are 2 by 10 net 30. Meaning what? If the credit term of the business is 2 by 10 net 30, means credit period allowed by the business is 30 days. Okay. So if you will purchase the goods today, you have to make payment within 30 days. But if you pay within 10 days, you will get 2% discount. So you have to read this like this. 2 by 10 net 30 means company give the 30 days time to the customer to pay the amount. But if they are making payment within 10 days, they will be given 2% discount. Understood? So suppose everybody tell me what will be this 3 by 10 net 40 means. How you will read this? What is the normal credit period given by the company? Three by 10 net 40. Yes. 3 by 10 net 40 means credit period normally given by companies 40 days. But they are saying that if the customer will pay the amount within 10 days, we will give him 3% discount. Okay. Now you can select. If you are paying the payment within 8 days, you will get 3% discount. You are paying within 10 days, you will get 3% discount. But after that, if you will pay, you will not get the discount. Okay. So suppose if you are paying on the 12th day, you will not get any discount. So better pay by 40 days only. So you see that if you are paying within 10 days, we will give you 3% discount. Otherwise, you can pay till 40 days. Understood? Okay, some more terms are there that we will discuss in the next class. Today we are stopping here. So whatever we are discussing now, you make a note of it in a notebook. It will be useful for you while preparing for the examination.